Hey, did you know that many Canadians are losing 30 to 40% of their retirement income? Well, in today's video, I'm going to share with you how we help our clients avoid that fate and retire with more after-tax income. Well, in today's video, I'm going to be sharing with you the problems that many Canadians are facing when it comes to retirement, paying too much tax, cumulative throughout their lifetime, leaving too much money behind in their estate that will be taxed, and you're all trying to figure out how do you do the RRSP withdrawals. So in today's video, I'm going to be talking about an RRSP meltdown, a RIFF meltdown, doing a RIFF minimum only, and sharing with you what is really a tax efficient withdrawal strategy and comparing it all side by side so you can see which strategy works best and which strategy you really want to avoid doing. So I hope you enjoyed today's video. Remember to put your comments below. I love reading your comments, and remember to like and share this with anybody that wants to learn more about retirement planning and how to retire with confidence. Okay, let's get into why you're here today. Let's look at what is the problem. The hidden cost of poor planning is the problem that you're facing. By not having a strategy or a retirement plan, you're kind of winging it. You're doing your best. You got Excel spreadsheets, you got calculators, you got other people giving you advice, and you're trying to just sort of eyeball your way as best as you can. That is not a good idea. I would recommend that you get a retirement plan done, whether you go to someone like me or go to someone that can prepare even a modest retirement plan that can get you headed in the right direction. But of course, I would endorse getting a proper plan done by a qualified person such as myself. So let's dig into what that might look like. Okay, here's the problem. Problem is you're investing in an RSP. Now that's not the only problem. I know many of you don't like RSPs, but they're actually an effective retirement tool, but used poorly, it's really going to cause you a lot of misery and grief with taxation. The other part of that, which I'm not going to focus on today, is the tax-free savings account. Many of you are overfunding your RSP and underfunding your tax-free savings account. That account offers you a great deal of flexibility because when you do your withdrawal strategy, it can prevent you to have to take more money out of your RSP. By using some of your tax-free savings account and your non-registered account, you can lower the withdrawal rate in your RSP and pay less tax. But I'll show you that later on. I don't want to give away too much of before we get into it. So many of you are doing this. You invest in an RSP, then you're getting to retirement, you say, well, I got CPP, I've got old age security, maybe you have rental income, maybe you have a small business giving you some income or a private pension. So you say, I really don't need the RSP income, so I'm going to leave it alone and I'll take it at 71, I'll convert it to a RIFF and start receiving the income. So I'm going to defer that as long as I can because I don't need it. In fact, a few years ago, the government changed the rate. They reduced the amount or the percentage that you have to take because many Canadians were putting their hand up and saying, I don't need all this money. Can you please lower the minimum withdrawal? And they did. But you all have, well, not all of you, but many of you still are deferring taking your RSP until age 71. And I'm going to share with you why that might be not the best idea. Okay, so let's look at that. When that happens and you need more money, and especially if you're not putting money in a TFSA, then you have to do larger RRSP withdrawals to satisfy your lifestyle expenses. So let's say you have an unusual expense that year. Maybe it's repairing something very expensive in your home or medical care. Maybe it's that bucket list trip. You just wanted to take that before you know, mobility issues set in. And so you have to do a big withdrawal out of your RSP or out of your RIFF, and that drives up your tax rate and possibly creates an old age security clawback. So not the best idea. So let me show you what that looks like. Many of you may not know what the RIFF minimum is. If you just Google RIFF minimum withdrawal, you'll see a table that looks similar to this. And you can see that I'm just showing from age 65 to 87. There's years before and years after, but the example I'm sharing with you is within that scope of years, so I'm not going to bother. And plus, it doesn't fit on this screen, so I'm doing it that way. What we're focusing on is age 71 and 72. So if you look on the left-hand side, you see 71, 72, and what you're looking here is go across to the percentage. At age 72, that is the year in which you'll have to start receiving money from your RIFF. that is mandated, and it's 5.4%. So how does this work? Wherever you have your money, let's say it's at a bank, and you have the balance at December 31st, whatever that balance is, times 5.4%, that's how much money you'll have to take out the following year. The next year, you're 73 years of age, you track across, now it's 5.53%. So in some videos, I talked about sequence of returns and talking about how long your money will last. If you're taking out 5.4% of your money and you're growing your money, let's say your return is 8%, chances are you're not getting through your RSP that fast. But if you go down further, 84, 85, 86, 87, now you see it's 9.55%. And when you're 87 years old, chances are your risk tolerance is much lower. So you might be getting maybe 4.5% rate of return in your investment portfolio by drawing down at 9.55. That's the RIFF minimum withdrawal. Okay, that's how that works. So now let's look at what happens if you only take the RIFF minimum withdrawal. Well, these motorcycles that drive by, they just make a lot of noise, so I apologize. But okay, here's a spreadsheet. This is the financial plan that this is a software that we use. And if you look at this column on the left-hand side, there's your age. What we're gonna track across from age 72 until we hit the RSP column. You'll see that number, $72,098. That is the money that has come out of your RIFF. You got $1.3.5 million, and they have to take $72,000 out of the RIFF. Now, the software also says, based on your expenses, you may need to take more out to satisfy lifestyle expenses. But essentially, your first inclination was, I don't need my RIFF money, I have all this other income, I'm just going to do the RIFF minimum withdrawal. If you do that, look what happens. Go all the way down to the bottom, and you see at age 84, let's say this person passes age 84, and they're single, let's say, $1.1 million is what's left over. So what happens if you don't have a spouse? If you have a spouse, the money goes to your spouse. But when they pass away, situation is the same as a single person. This $1.1 million gets added to your tax return in the year of your passing. So if you earn $1.1 million in a given year, what do you think your tax rate is? It's crazy, right? You don't want to have that situation happen. So that's not a good idea. In the other columns, you just see a tax-free savings account, non-registered. They're filling up their tax-free savings account every year, and they're using some of their non-registered. And then you see actually they're not. They actually have a surplus of cash, and they're just saving money at that point. But the RIFF, it doesn't matter how much money you have in the other two accounts. That's the minimum that's coming out of the RIFF. So what happens when you only do RIFF minimum? Let's go and get into that. So you go, that's not good. I don't want to leave money behind. So let me think. I will take out enough money each year so that by the time I'm 85 or 80, let's say 83, I don't have any money in my RIFF. And what I don't need, I'll put it in my tax-free savings account. And if I don't have room in my tax-free savings account, I'll put it into my non-registered account. And that's what you see happening. Look across at age 72. They take $150,000 out. They put $9,000 in their tax-free savings account, and they have $53,000 being saved in a non-registered account. Now, don't take out your calculator and say that doesn't add up. Yeah, it adds up because we're also paying tax on the withdrawal of the $150,000, right? Don't forget. So in this case, if we do the $150,000 every single year, by age 83, they will have taken the money out of their RIFF, voluntarily paid the tax, and then just saved what they're not spending. And bravo, no money in your RIFF account for kind of revenue to tax. Well done. But have a look at the tax rate. The tax rate went from 19% to 25%. That's like one action created another problem. So you really have to do a withdrawal rate that's going to be able to pay less tax over time. So it's not just simply about what's the tax in your state, but also what is the cumulative tax over your lifetime. And that's what I'm going to share with you, how you do that. Now, what you really want to do is you want to think about, well, what is an RRSP meltdown? What's a RIFF meltdown? An RRSP meltdown obviously is you have an RRSP account. You haven't turned it into a RIFF. And what you want to do is you want to begin doing RRSP withdrawals earlier rather than leave it till age 71. And when you do this, that flattens out your tax rate. Instead of spiking your tax rate, you'll pay less tax cumulative over time, and you'll leave nothing behind for Canada revenue tax. So let's show you how that's going to work as well. So what we want to pay attention to is something called income sequencing. Instead of just guessing, we build a plan to draw income in the most tax efficient way. And this is going to just relieve you of so much, anxiety. You guys are thinking about this not all day, but it's on your mind. It's in the back of your head. You're saying, what are we supposed to do? So dig in, go to an advisor that does planning, such as myself, and get a proper plan done. So we're going to use tax-free savings account when we need to. If not, we're also you're going to store that money. We're going to use non-registered accounts to augment the withdrawal that has to happen in your RRSP, so you're not drawing so much money out of your RRSP in any given year. We're going to consider doing the RRSP meltdown, and if there's more money left in your RRSP at age 72, then it becomes a RIFF meltdown. And we want to look at what's the optimal age for you to begin receiving your CPP and your old age security. We want to do all of those things in order to make sure you pay less tax. So this is like you're gonna love this. Now, just before I show you, I'll just share with you one idea, and that is if you have a business, if you're an incorporated professional, this works even better for you because there's a number of different tax strategies that will help you lower your tax and have a lot more after-tax income. One of them is obviously using whole life insurance. So you can look at this video up here. Again, which finger do I point? I don't remember. And when you use whole life insurance in your holding company, it's like having a TFSA with no limits on it. And before you get all crazy and wild about what the words I'm choosing, a TFSA with no limits, obviously that doesn't exist, but the idea of whole life insurance is very similar to that of a TFSA that has no limits. And I'll just watch that video and you'll understand why. Okay, so this is an RRSP and taking into account taxation. So we are doing withdrawals and being mindful of what the tax rate is at the same time. So how do we accomplish this? Look at age 70. Actually, look at age 65 to 70 on the left-hand side. You'll notice that we've pushed CPP off, so delayed it till age 70. Same with old age security. And that allows us to draw down in the RSP sooner instead of later. So we got, if you look at the column of RSP, 100,000, 100,000, and then we lower it to 22 and then back to 50. And so we're being mindful of how much to take out, that we know that we're going to get out of the RIF by or before age or by age 84. But if you look at the effective tax rate, we're in that 19 to 20% most of the way through. In the very beginning, there's a couple of years where there's 21, but most of the way through, we're at 20%, 19, 20%. You may recall in the previous one where you just decided to take a straight line, $150,000 a year, the tax rate was over 25%. So the same thing is being accomplished here in getting out of the RIF by age 84, but we're doing it with paying less tax along the way. And what does that do? Well, the money is that you're not spending, same thing's happening, that is going in your TFSA and it's going in your non-registered account. So it's just a better way to do the RRSP meltdown and then RIF meltdown, is being mindful of the tax rate and pushing off CPP and old age security. So let's look at this. I mentioned at the very beginning we're going to compare them side by side. Okay, on the left hand side are the measurements that we're going to be looking at, and then we're going to say, okay, the second column is the RIF only, then the middle column here is RIF at age 71, so push it off to age 71 and do a meltdown of $150,000 a year. And then the third scenario was the one that we just reviewed, where it's not $150,000. We're picking and choosing our moments throughout time, those years, of how much to withdraw. So let's look at the first row, lifetime personal tax. That's the cumulative amount of tax between today and your passing. If you did a RIF minimum, you wouldn't pay that much tax because you're not really drawing down on it. It's only just under $1 million. If you did $150,000 a year, you're going to be 1.4 million. And if you did the tax efficient withdrawal, it'd be 1.3 million. So obviously you don't leave the RIF minimum. You need to get the money out, because at the bottom you'll see why. Lifetime government benefits. If you do a RIF minimum withdrawal, you're going to receive 1.5 million in CPP and old age security. If you do a drawdown of $150,000 a year, you're going to not get as much, 1.3 million. And if you do a tax efficient withdrawal, you're going to avoid old age security clawback. You're actually going to increase your benefits because you're deferring to age 70, so you get 1.8 million. That's a significant difference. It's really important for you to pay attention that you're getting more money. In fact, you're getting more guaranteed inflation adjusted income in your retirement by doing that way. And obviously the middle column, with just doing 150,000 straight line withdrawal, you're losing $240,000 of your old age security. So not ideal. One strategy to get out of the RIF creates another problem, right? So you want to be mindful of how to do it in a better way. If you look at the estate before tax column and then just focus on the tax on the estate, in the first scenario where you only did a RIF minimum and didn't focus on taking anything else, you leave behind nearly $1.2 million for Canada revenue to tax your estate. So you're left with $6.9 million after tax. The other column, $150,000 a year coming out. Great. We avoided that tax. $40,000 you have to pay in that year because you have a large non-registered portfolio that you're paying tax on. But you end up having $6.8 million. Pretty close to do nothing and just let the RIF minimum happen. You're at least going to have about the same estate value but pay less tax, estate tax to the government. So that's beneficial. The third one, the tax efficient withdrawal strategy, is you pay $56,000, so a little bit more in terms of doing the meltdown, the $150,000, but certainly a lot less than 1.8 million, 1.2 million, and you end up having more estate value, 7.2 million versus the 6.9 and the 6.8. So you can see that doing the tax efficient strategy was much better. If you look at the outcomes, we increased the CPP and old age security by $250,000. That's $250,000 in your pocket. We lowered the estate tax by $1.1 million and increased the estate value by $222,000 by just taking the time to work with an advisor to go through an efficient, tax efficient withdrawal strategy. This is the outcome. I don't care what you're paying. If you're paying to get a plan done, these numbers justify you going and paying somebody to do that. Just point blank. Forget about that I'm biased and I'm telling you should get a plan done. If you get this kind of result done, it was worth your time and your money every day of the week. Okay, so I would say to you, don't put this off. CRA is not going to send you a letter and tell you, hey, by the way, you're going to lose 40% of your retirement assets. They're not going to do that. That's the job of the advisor that you're working with. Now, it's not the job of every advisor. If you're working with an advisor whose job it is just to multiply your money, right? Maybe you're working with a broker that doesn't do any retirement planning. They're doing their job. Hopefully, they're making you money. They're doing their job. Their job is, they don't really care about what you want to do in retirement and where you're going to spend your money. They had one task, they're doing it. What you need is an advisor that does retirement plan. And that's what they do every day. It's not an advisor that says, yeah, I can do that for you. You want an advisor that says, yeah, I do that every day of the week, or at least every week they're doing retirement plans, because they know the software like this, they know the strategies, the rules. You'll have a better outcome working with someone in that environment. So if you're over 45 years of age, approaching retirement, or concerned about your retirement, you have at least $500,000 to invest, I'd ask you to consider contacting me so that we can begin doing a retirement plan for you and see how we can help you save more money from taxes and have more retirement income for you and enjoy your retirement. Well, I appreciate you coming to see this video and sticking with it. I really want to say thank you, absolute gratitude for you to watch my videos, and I look forward to seeing you in the next videos. Thanks, and be well.